All right, ClinchCapital here. I'm gonna be ranking 11 different ETFs, some of the most common ETFs out there, and I'm gonna be ranking them on a scale of S as the top tier through D. This is not financial advice, just my opinion, and I'm basing this on the idea that you'd be holding these stocks for a long time, these ETFs for a long time, not like day trading these things. So let's get started. The first one we're gonna look at is the SPY. SPY is kind of like the legendary, one of the oldest ETFs around. It's essentially just tracking the S&P 500. It's like a really common one. A lot of people will talk about it. A lot of people just base everything on the SPY, which tracks the S&P 500. However, the S&P 500, the one thing it has that it kind of like has lost its edge in the few years is its expense ratio is too high. So if it didn't have such a high expense ratio, it would get a higher ranking. But because there are options now that pretty much do the same thing and have less in fees, making it so you save more money over time and have more compound growth, it's getting a B tier. So SPY is our first one there, and it's placing at B tier. Now, the next one we're going to talk about is very interesting. This is more of a speculative ETF. It's kind of an oddball on this list, but this is QTUM. This is the quantum computing ETF. It's going to be a basket of quantum computing companies. Quantum computing is the idea that like these computers now that they're starting to be created. I think Intel and Google have made some quantum chips now, but the idea of it is like a normal computer can do one problem at a time, albeit very fast, multiple problems in a second, but it just has to go from one problem to the next. A quantum computer could do multiple problems at a time, theoretically being a much faster computer. Quantum computing, if this becomes like a popular thing, a normalized thing, I think we'd see a really crazy change in technology more than it's been already. Essentially, this would be like AI on steroids. So, what quantum has going for it is it seems like it could be a market leader in that sense. However, it's got high fees and you can get stuff that tracks similar companies for a lower fee. However, if you're very bullish on the idea of quantum computing, it might be something to look into. But because of the fees and because of the idea you can get other companies at a discount, essentially, I'm gonna be ranking this in the D tier. So QTUM is getting a D tier ranking. Now, we talked about the next one is going to be VTI. VTI is essentially you're getting exposure to the entire U.S. investable market. This is going to include small mid-cap companies that some of these other ETFs miss, like the S&P 500, and you're getting the same low fee as a lot of these ETFs. So you're getting more diversification, and you're getting a low fee. So VTI is going to be our first S tier ETF. You're getting total exposure to the U.S. market, and you're getting a low fee there. It's kind of hard to beat. Now, if you're focused on growth, you might not want to have total exposure. You might want to have a higher concentration of like essentially the Mag 7 or the top 100 shares or top 100 stocks. So moving on from that, let's look at another one. Let's look at VEA. So VEA is Vanguard Developed Markets. And this is like a fund that provides low cost access to established international economies. So this is giving you exposure to the international market, the developed ones. So it's going to be like Canada, exposure to these international markets. However, historically, the international markets have outperformed by the US. So for that reason, it's going to be ranking at a C tier. However, in the last year, I think international markets, I think they beat the S&P 500 last year. And I did remember reading about Europe having some big goals for energy this year, so we will see what happens. Might be something to look into. Now, moving on from there, let's go right to QQQ. QQQ is essentially the 100 biggest stocks in the United States, and you're getting exposure to all 100 of those. All of those are growth and tech oriented. So if you're a younger person focused on growing your money as fast as you could, that's where QQQ would come in. However, it has a high expense ratio and there is a better option than QQQ. So for that reason, it's ranking in the B category. Now let's go right to the best, which would be QQQM. It's investing in the same thing as QQQ, but you're getting a much lower expense ratio of 0.15. This is like the superior choice for a tech-heavy growth. It's going to maximize your long-term compounding and cut out like any unnecessary fees. So for that reason, QQQM is another S tier ETF. That's one of the top dogs up there. Right after QQQM, let's go into another growth-oriented ETF. We're going to look at Vanguard Growth. This is an effective tool for investors who want to lean heavily into like aggressive, high growth companies. I'm talking like Apple, Amazon. It's got an incredible performance history and a really low fee. And the fee is really low. It's significantly low. Younger, let's say 20s, 30s, growth in your portfolio is going to be something I would recommend. As you get older, you probably want to look at more stuff like dividends, eventually, or gold, some stuff like that. But having those growth being if you're able to deal with the volatility, you're taking more risk, more reward essentially with the growth funds. Balancing off that, let's say you're a little bit older and you want to have more safety or you just want less risk. SCHD, arguably one of the best like quality funds on this list. SCHD focuses on companies with really strong balance sheets and a consistent dividend growth. It's essentially like a portfolio stabilizer and a fantastic one at that. It's going to be providing reliable cash flow and it's going to have more protection during a volatile market cycle. Historically, when recessions hit, the dividend stocks are hit the lowest, so having a dividend ETF would be a good way to have some protection going into market volatility. Now, the catch of that is you're getting more protection, but you're getting a little bit less risk, a little bit safer, a little bit more of like a stability play. And we're going to rank this SCHD here at the A tier. Let's move on from this though and go look at another kind of oddball here. We're going to call this like a hedge ETF. This would be a hedge against the dollar. And this is GLD. This is essentially gold, paper gold at that. So because it's gold, it doesn't generate earnings, dividends, or have much innovation. Although a lot of the new technology is using like gold and silver. I know a lot of the electric cars now have like a good amount of silver in them. A lot of missiles use silver, but a lot of these newer computers, they got like chunks of gold in them to make them run more efficiently or whatever, regulate temperature. But this is paper gold. You're getting an expense ratio with this. So you're actually paying fees to have this managed, and that makes this a D tier because essentially you could use your money and just go out and buy physical gold, and I think that would be a better way to do it. You might be interested in GLD if you wanted to have gold exposure in a retirement account, or you were worried about like actually holding physical gold and maybe it getting stolen. But other than that, I don't see it as a very good idea unless you're worried about those two things. Moving on from there, let's go up to VT. So VT is the Vanguard Total World Stock. This is kind of an interesting one. More of a diversity play here. You're just diversifying, essentially investing in all the markets. You're getting global market exposure. It's kind of going to guarantee that you're not left behind if one international market begins to lead the way. It's essentially a safety play for investors who want to have like zero guesswork over which country is going to perform the best over 30 years. This you might be leaving some gains on the table, but you could sleep well at night. So he's going to rank up here at the B tier, and that is just investing in the entire global market. Kind of an interesting one. If you don't have much international exposure, it might be something to look into. And our last one, the final one, is VOO. This is the Vanguard S&P 500. This is like the gold standard for large cap exposure. You're getting exposure to the S&P 500, but you're paying a 0.03 expense ratio, and that's going to ensure that you keep almost every penny of the market returns. It's essentially the most efficient way to own the 500 largest, most profitable companies in the United States, and for that reason, VOO is S tier. All right, so that's my list there for you. I got all 11 of those ranked. I'd be interested if there's any other ETFs you'd like to see on a list like this in the future. And one more question for y'all, if you made it this far. First of all, I appreciate you. Maybe drop a like, leave a comment, subscribe. But my question is, would you be interested in seeing more of these tier list videos? And how would you feel about one of these list videos going in the back of some like gameplay, like Call of Duty going on in the background, and then me just casually putting up screenshots of the list? I'm not sure how you'd feel about that, but let me know in the comments. If you made it this far, appreciate you for watching.